Everyone, welcome back. Let's start our next video on hidden goodwill. Okay, we have heard about this concept of hidden goodwill in admission as well. What it is that a goodwill is not directly mentioned, or how to calculate it is not directly mentioned. So what we need to do, we need to somehow find the goodwill, and that is why it is called goodwill is hidden. So it's a hidden goodwill. So if the firm has agreed to settle the retiring or deceased partner's account by paying him a lump sum amount, then the amount paid to him in excess of what is due to him based on the balance in his capital account, and after making necessary adjustments in respect of accumulated profits and losses, revaluation of assets and liabilities, etc., shall be treated as his share of goodwill, known as hidden goodwill. So whatever he was supposed to get plus whatever he is getting, if he is getting more than what he is supposed to get, the difference is what? The difference is hidden goodwill. Okay, so let's have a look. Adjustment for revaluation of assets and liabilities. Let's see, we already know this. So at the time of retirement or death of a partner, there may be some assets which may not have been shown at their current values. Similarly, there may be certain liabilities which have been shown at a value different from the obligation to be met by the firm. So our assets, so our liabilities are not at what they are supposed to be. Okay, the values are different. They do not resemble the market values or what we have to pay to the liabilities. So what we need to do, we need to revalue our assets and reassess our liabilities. So not only that, there may be some unrecorded assets and unrecorded liabilities which need to be brought into the books. So a revaluation account, do remember revaluation account is also called P&L adjustment account, profit and loss adjustment account. Okay, it is also called P&L adjustment account. Is prepared in order to ascertain net gain or loss on revaluation of assets and or liabilities and bringing unrecorded items into the firm's books, and the same is transferred to the capital account of all partners including retiring or deceased partner. Do remember this is that even he is the old partner, the retiring or deceased partner, the revaluation profit or loss should also go to him. Okay, in their old profit sharing, we always used to do what? We used to transfer it in old ratio. Do remember? Okay, it's just like admission. Okay. Now let's look at illustration number 10 on page number 181 of our NCERT book. Yes. So illustration number 10 is Mitali, Indu and Geeta are partners sharing profit and losses in the ratio of 5:3:2 respectively. On March 31, 2017, their balance sheet was as under. Let's look at the balance sheet. So Mitali, Indu and Geeta's capitals are there, sundry creditors and general reserve. Do remember in this chapter also general reserve will be distributed amongst the old partners in the old ratio. Next is goodwill. This is already mentioned, already in the books of accounts. So what we need? We need to write it off. We need to distribute amongst the old partners in the old ratio. Buildings, patents, machinery, stock, debtors and cash. Geeta retires. Who's Geeta? The last one. Okay, so ideally it should be 5:3, the new ratio. Let's see. It was agreed that machinery be valued at 1,40,000. So machinery 1,50,000, 10,000 is the revaluation loss. Patents at 40,000. So patents 10,000 revaluation profit. Building at 1,25,000. So 25,000 revaluation profit. Record necessary journal entries for the above adjustment and prepare the revaluation account. So guys, what is the first of all in the new ratio? The new ratio, I told you, if nothing is given, how they are taking their share. What you need to do, whosoever is going, just put your hand on it. okay, on that person's share, and we'll find out 5:3 is the new ratio. Okay. Let's look. First of all, machinery 10,000 devaluation is going on. So revaluation debit to machinery. Patents and building, there is the profit. So the assets are debiting and revaluation account is getting credited. And finally, the revaluation profit of 25,000 is being distributed amongst all the partners, okay, including the retiring partner in their old ratio 5:3:2, okay. And the balance sheet, see, patents will, okay, it's not the balance sheet, it's the revaluation account. So patents and buildings, profits, the machinery loss, rest 25,000 is the profit. Okay, let's look at our new topic. Adjustment of accumulated profits and losses. Okay, we all remember what is to be done with the general reserve or P&L debit or credit balance. Okay, what we need, sometimes the balance sheet of a firm may show accumulated profits in the form of general reserve and or accumulated losses in the form of P&L account debit balance. The retiring or deceased partner is entitled to his or her share in the accumulated profit and is also liable to share the accumulated losses, if any. These accumulated profits or losses belong to all the partners and should be transferred to their capital accounts of all the partners in their old profit sharing ratio. We have already discussed this, just a quick revision. Now, when partner retires in the middle of the year, see, generally what happens, I told you, death can happen in the middle of the year or any other date. But retirement, generally what happens, they decide, okay, complete the entire year and then go, okay. Now, he is adamant, no, I want to go right now only, it's in the middle of the year. So what will happen? Normally, retirement of a partner takes place at the end of accounting period. But there can be a case where a partner decides to retire in the middle of the year. What will happen if they are retiring in the middle of the year? So, in such a case, the claim shall include, so whatever we are giving to him shall also include share of profits or loss, interest on capital, interest on drawings, if any, from the date of last balance sheet to the date of retirement. So, let's say he retired on 1st of October, so April to 30th September, 6 months. Firm must have incurred some profits or some losses, or there should be some interest on capital, or if he is withdrawn, there is some interest on drawings, okay, anything. Even these will be accounted for 6 months. If the firm owes to him, the firm will give. If he has to give money to the firm, that will be debited from his capital account. Here, the main problem relates to the calculation of profit for the intervening period. That is the period from the date of the last balance sheet and the date of retirement. So what will happen? Disposal of amount due to retiring partner, how we are going to give the money to the retiring partner, whether we have to give or we have an option not to give. Let's look. The outgoing partner's account is settled as per the terms of partnership deed, that is in lump sum, immediately, or in various installments, or without interest as agreed, or partly in cash immediately and partly in installment at the agreed intervals. This is the type of question we are expecting in our board examination also, where see, it cannot be two balance carried down for the retiring partner. I told you earlier also why it cannot be, because he is now retiring, the balance will not be carried down, it needs to be settled, okay. Now the firm might not have enough money to settle, so it will be settled according to the partnership deed, okay. Sometimes generally the question that we actually expect in board examination is some amount is given in cash, rest it is agreed that okay, we are considering it as your loan and we will pay EMI and I will give back the entire money in 3 years or 3 installments like this. In the absence of any agreement, Section 37 of the Indian Partnership Act 1932 is applicable, which states that the outgoing partner has an option to receive either interest at 6% per annum till the date of payment, or such share of profits which has been earned with his or her money. That is based on capital ratio. Now, disposal of amount again due to retiring partner. Hence, the total amount due to the retiring partner, which is ascertained after all adjustments have been made, is to be paid immediately to the retiring partner. In case the firm is not in a position to make the payment immediately, the amount due is transferred to the retiring partner's loan account, and as and when the amount is paid is debited to his or her account. Now guys, this is what we are going to do, how to prepare this loan account. And that we'll be studying on illustration number 11 to 13. Okay, let's come on page number 186. Yes, so illustration 11 is Amrinder, Mahinder and Joginder are partners in a firm. Mahinder, the middle one, okay, retires from the firm. On the date of retirement, rupees 60,000 becomes due to him. Amrinder and Joginder promise to pay him in installments every year at the end of the year, to which he agreed. Prepare Mahinder's loan account on the following in the following cases. When payment is made, 4 yearly installments plus interest at the rate of 12% per annum on the balance. So whatever they are paying, it's okay. Whatever is remaining, 12% per annum will be interest. So first case, let's look when payment is made in 4 yearly installments. So what will happen in the capital? This is loan account. Before loan account, what will happen? There will be the capital accounts of the partners, where the continuing partner will have balance to balance carried down, but the retiring partner's balance will be what? Whatever is paid in cash to cash, but whatever is not paid to the partner's loan account. So to partner's loan account, the balance from there will come here by Mahinder's capital. Okay, so total 60,000 was to be paid. Now this payment is to be made at the end of the year, so entire year's interest will also be charged. Okay, what will happen in 4 equal installments? So we understood that the entire year interest becomes what? 7,200, 12% into 60,000, 7,200. So total payment is to be made at 67,200. Now this 60,000 is to be divided into 4 equal installments, so 15,000 each. So whatever you are paying to bank is 15,000 plus whatever is the interest. Always assume that interest is separately paid. If it is not separately paid, then the question will give you specifically. So totally we are paying 1/4 of 60,000 along with 7,200 interest. So 45,000 is still remaining out of 60. 45 is still remaining. Year 2 comes, okay, this 45 is the carried down balance, so it becomes the brought down balance. On 45,000, 12% for the entire year comes to 5,400. So we have to pay 45 and 54. Now, at the end of the year, we are paying 1/4 of 60, that is 15,000 plus the interest. So this is carried down, again brought down. The entire year's interest is 3,600. So the 15,000 EMI plus 3,600 interest is given. So carried down is 15. On 15, 1,800 is the interest, and totally interest EMI plus interest both are paid and the account is settled. Okay. The second is when payment is made in 3 yearly installments of 20,000, including 12% per annum outstanding balance during the first 3 years and the balance including interest in the 4th year. So in this 20,000, even the interest is to be included. So we need to understand how much is the interest part and how much is the principal amount. So because the interest is calculated only on the principal amount. So see, again 60,000 is coming in from Mahinder's capital account and 7,200 is the entire year's interest. Now we know bank from to bank, what will happen? 20,000 will only go. This 20,000 will contain the interest portion as well as whatever the principal portion is there. So how much is the interest portion? 7,200. So out of 20,000, if 7,200 is the interest, how much? 12,800 is the principal. 20 minus 7,200. So from 60, 12,800 is deducted. The balance is what? Balances are principal. Now next year this will be carried down, and on this amount 12% will be charged, but the payment will be 20,000. So whatever is remaining is the principal. Okay. Again, in the same way, in the last year, 16 plus, see last year to bank, it's not happening in full 20 because it was written in the fourth year, whatever we have to pay. We just had to pay 18,825. So that much we are going to pay. Okay. Yeah. And when payment is made in 4 equal yearly installment including, now here equal installment including interest, the installment should be calculated by annuity table. Before going into this, let's read the note. The annual installment of payment in 4 years at the rate of 12% interest works out to be rupees 19,754. Annually 0.329234 as per annually table multiply by, this is not annually table, this is annuity table. Okay, ANNUITY, okay, annuity table. Okay, what is annuity table? How to calculate installment? I'll just tell you in a bit. Okay. Yeah, so to calculate annuity, I tell you this is not in your syllabus anymore. So if you need just extra info how to calculate EMI, now do remember EMI also include your principal as well as interest, but the outflow needs to be exact every year. See, now obviously the interest is different, the principal is different every year. Okay, so how to calculate? You will be needing a calculator for that. It will be easier, and as the calculator is not allowed in your syllabus in 12th standard, that is why it is not in your course. So I'll tell you. Let's say how much we have to pay. Principal we had to pay 60,000. Okay, what is the interest? Is 12% per annum. Okay, now we need to calculate EMI. Okay, how to calculate EMI? What you need to do is, first of all, the 60,000 divided by 1 plus interest. So 12% is 0.12 raised to the power, how many years? 4 years. Okay, so okay, and this is auto sum. So we need to calculate every year's interest. Okay, and then add it. So this become, the first year is I'll do 60,000. I'm just taking it out, and let's say the first year 1 upon 1.12. Okay, raised to the power 1 plus 1 upon 1.12 raised to the power 2 plus 1 upon 1.12 raised to the power 3, and the fourth year 1 upon 1.12 raised to the power 4. Okay, and what we need to do, we need to calculate and add. Okay, and then multiply with this. So 1 divided by 1.12 comes to 60,000 multiplied by the first year is 0.89285. 0.89285. I'm 6. I'm writing 6 plus second year is 0.797. 193. Third year 0.71178. 78, and the fourth year 0.63551. Okay, let's add all this. So 1 by 1.12. Yeah, so it is coming as 60,000 multiplied by 1 upon 3.0373. Okay, so if I divide 60,000 by this, we get 60,000 divided by 3.0373, we get 19754. and some decimal. Okay, so this is our equal EMI, and that's how you need to have to calculate EMI. But again, telling you, not in 12th syllabus. Okay, this is not in your 12th syllabus. Just if you wanted how to calculate EMI, that's how you calculate EMI. Okay. Now we know that 19,194 is the EMI. So every year this much money will go. Okay, and whatever is the balance, will the interest we obviously will calculate on that. EMI will go that much only. The balance like this we have to calculate. Next is illustration 12. The balance sheet of Ashish, Suresh and Lokesh, who were sharing profits and losses in the ratio 5:3:2 is given below as on March 31, 2017. Balance sheet is given: capitals, reserve fund, creditors, outstanding expresses, no expenses, land, building, plant and machinery, furniture, stock, debtors and cash. Suresh retires. Who's the Suresh? Suresh. Okay, now his Suresh here. Shyam Gagan Ram. So, name are different. Ashish, Suresh, and the middle one should be Suresh, I believe. Okay. Furniture and fittings. Stock valued 172. Furniture fitting 80,000. Profit share of Suresh till the date of retirement is to be calculated now on the basis of firm's last year profit, which is 2 lakhs. So when is Suresh retiring? See, Suresh is retiring on 30th June. So he's there in the business for 3 months. So he should get 3 months profit, but the year is already started. We don't know by how much profit or loss we'll make by the end of the year. So they have agreed, okay, for the calculation, let's assume this year also will make the same profit of the last year. So Suresh, your share in total profit multiplied by, you were there only for 3 months. So you'll get only for 3 months profit. An amount of 10,000 due from Mr. Deepak, a debtor, was doubtful and a provision is to be required. Goodwill of the firm valued at 2 lakhs. Suresh was paid 40,000 immediately on retirement, and the balance was transferred to his loan account. And the Ashish, Lokesh were to share profits in the ratio of 3:2. So new ratio is there, old ratio is there. We can find out the gaining ratio so that we can do the goodwill adjustments. So first of all, revaluation. Stock and doubtful provision is our loss. Furniture revaluation is our gain. In all, there is a loss on revaluation, which loss is divided into 5:3:2. Their old ratio. Now their capitals has been bought down. The reserve fund has been distributed. Okay. Now just look at it. The revaluation loss is here. This time, how much this Suresh should get? So Suresh should get how much? His share was total profit of the last year was 2 lakh, multiplied by what was his share? 3, 5:3:2, so 3 upon 10, multiplied by, he was there for 3 months only, so he should get only for 3 months. So if we solve this, 3, 1, 3, 4, 4, 1, 4, 5, 0, 0, 0, 5 3 is 15. So 15,000. Now this is his share of profit. So should be P&L account. But why this P&L suspense is given? Because the other remaining partners don't know whether they'll make exact 2 lakh, they'll make more than 2 lakh, they'll make less than 2 lakh. They don't know yet. So it's still a suspense for them. So they have written, always write whatever you give in the middle in P&L suspense account. Now, Ashish's capital, Lokesh's capital is what? This is the goodwill firm thing. Goodwill was 60,000, I believe. Goodwill was 2 lakh also. So his share was 60,000, which is given in the gaining ratio of 1:2. So 20 and 40, who is giving? Ashish and Lokesh are giving to him. So his capital is increased. They are giving, so their capitals are decreased. Now, what we'll do, we'll just adjust Ashish and Lokesh. But when it comes to Suresh, we understood that we need to give him 544 minus 6. Okay, 4,38,000. Now we don't have 4,38,000, so to cash immediately. Okay, to cash to cash immediately 40,000. Rest of the money is in transferred to Suresh's loan account. Okay, and obviously there cannot be any balance for Suresh. Okay, the balance sheet, Ashish and Lokesh's capital there, so they have still not paid Suresh, so it's in loan, liability, creditors, outstanding expenses, rest we already know. In cash, 121 minus 40 because that has been paid to Suresh, and the P&L suspense is an asset, it's a miscellaneous asset. Okay, that will come in our balance sheet asset side. And the last illustration and last thing for this lecture is Shyam, Gagan and Ram are partners sharing profits and losses in the ratio of 2:1. Their balance sheet as on March 31, 2017 are as under sundry creditors, employees, provident fund. Okay, it is an external liability, it belongs to the employees, it does not belong to the partners. General reserve, it belongs to the partners. Then Shyam, Gagan, Ram capitals are given. Cash, data, stock, machinery, building, patents. Let's see. As Gagan got very good break at an MNC, so he decided to retire on that, and it was decided that Shyam and Ram would share the future profits in the ratio 5:3. Goodwill was valued at 70,000, machinery at 78,000, building at 152, stock at 30,000, and bad debts amounting to 1550 were to be written off. Record journal entries in the books of firm and prepare balance sheets. So it is very simple. We already know the revaluation entries, the revaluation profit is being given to all the partners in the old ratio. Reserve is to be distributed among all the partners in the old ratio. Now what is this? This is an adjustment for goodwill. So gaining partners to the sacrificing partner. Now see, totally what was amount payable to him, that was 1,80,000, but the firm, you can see how much cash is there, 8,000. It is not mentioned, it is to be transferred to the loan account, but we can see the firm's position is not there to pay the entire amount in cash, so it is obvious that it will be transferred in the loan account. That also you need to be very careful. Okay, it is being transferred to the loan account, and that's our balance sheet. Okay, employees provident fund, I told you it's an external liability, the partners cannot divide it. Capitals, Gagan's loan, rest all the things you know, and this is our loan account and partners capital account. Okay, building, machinery, capital, balance, revaluation profit, reserves, Shyam's capital. So this is the goodwill amount that is being given to him and being taken out of the giving partners. So whatever is the balance for him will be in loan, and you can see the note, as sufficient balance is not available to pay the due amount to Gagan, the balance in his capital account is transferred to the loan account. You have to be very, very careful and vigilant about this. Thank you for watching. We'll be doing some very soon.